I'm kind of thinking Bitcoin finishes this cycle closer to 250,000. Global debt is 400% of global GDP. Whatever you think you own, you don't actually own. It can be taken away from you. Bitcoin finishes 150 to 250,000. I.e. it does a few X the last all-time highs. So I want people to understand that everything humans do is basically a contract. All societies are organized by contracts. What is this smart contract business?
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day. In examining the interplay between Bitcoin price predictions and the looming specter of global debt, several critical points emerge, shedding light on the potential dynamics that may shape financial landscapes in the coming years. Firstly, Bitcoin's trajectory in its current cycle appears to be heading towards a noteworthy milestone, with projections pointing towards a culmination closer to the $250,000 mark. This forecast is not merely speculative but rooted in the historical patterns and market dynamics that have characterized Bitcoin's ascent thus far. The cryptocurrency's finite supply coupled with growing institutional adoption and increased recognition as a store of value contribute to the bullish sentiment surrounding its price trajectory. Simultaneously, the global economy grapples with the staggering weight of debt, which has ballooned to an alarming 400% of global GDP. This unprecedented level of indebtedness poses systemic risks, potentially exacerbating financial instability and constraining avenues for sustainable economic growth. Mounting debt burdens encumber governments, corporations, and individuals alike, underscoring the urgency of addressing underlying structural vulnerabilities within the global financial framework. Moreover, the specter of asset seizure looms ominously, as evidenced by instances where ownership rights are arbitrarily revoked or compromised. In an era marked by heightened geopolitical tensions and regulatory uncertainties, individuals face the unsettling prospect of having their assets expropriated or confiscated without due process or recourse. Such vulnerabilities underscore the imperative of safeguarding financial sovereignty and preserving avenues for individual autonomy in an increasingly interconnected and digitized world.
How I think of it, I think there's a 60% chance that it's just a normal crypto cycle. So Bitcoin finishes 150 to 250,000, i.e. it does a few X the last all-time highs. There's a 20% chance that because of the ETF and how the economic cycle works, everyone gets overexcited about rate cuts, whatever, that we kind of front load it and it's short. But then there's another 20% chance that this actually extends further than we expect because institutions and others come into the space and it broadens out. So I think 60% chance normal cycle, 20% super cycle, 20% actually a short cycle. I'm kind of thinking Bitcoin finishes this cycle closer to 250,000. I think a lot of people are lower. I think it might be higher because of the dynamics of the ETF and other stuff. I'm pegging Ethereum between 15 and 20,000, and I'm pegging Solana between 750 and 1,000. So my view is Bitcoin starts the cycle and outperforms in the start. Then people go out the risk curve. ETH, we're going to have an ETH ETF. We'll see the market pick up there.
Right.
But the horse that's moving faster is the one that's coming from a smaller adoption base. It moves faster.
The approval of Bitcoin spot ETFs by the SEC in the United States marks a significant milestone in the journey of cryptocurrencies into mainstream finance. With several ETFs now greenlit, the impact on Bitcoin demand is poised to be substantial. Historically, Bitcoin has been an asset primarily traded on cryptocurrency exchanges, with limited access for traditional investors. However, the approval of ETFs changes this dynamic by offering a regulated and familiar investment vehicle, through which investors can gain exposure to Bitcoin without directly holding the asset. This regulatory approval is not only a testament to the growing acceptance of cryptocurrencies, but also has the potential to catalyze increased demand and liquidity in the market. By providing an easier entry point for institutional and retail investors, ETFs can broaden the investor base for Bitcoin and other cryptocurrencies. The initial response to the approval of Bitcoin spot ETFs has been overwhelmingly positive. ProShares Bitcoin spot ETF, for instance, witnessed a remarkable influx of capital, accumulating over $1 billion in assets under management within its first week of trading. This surge in interest underscores the pent-up demand for regulated investment products that offer exposure to the burgeoning cryptocurrency market. The approval of Bitcoin ETFs is likely to have ripple effects across the broader financial landscape. It could encourage other regulatory bodies around the world to follow suit, further legitimizing cryptocurrencies as a viable asset class. Moreover, increased demand spurred by ETF approval may also influence the development of cryptocurrency-related infrastructure and investment products.
Our actual problem is actually demographics. There's too many old people. And the old people all own equities, and they also have all the wealth. So if you were to allow the market to go down 70%, the people want, we want that bear market to show the bankers that they've done it wrong. We wipe out 70% of the wealth of America. You simply can't do it. And that's the collateral for all of the debt as well. So you blow up everything. That's what we learned in 2008, which was like, they're not going to go there. That was what Draghi did in 2012. It's like, whatever it takes, but we are not going to do that, which is the 1929 outcome. So what they're actually trying to do is rescue the baby boomers and rescue the governments who are trying to keep economic growth going with an indebted old population. So they're not trying to transfer money to the super wealthy. That was the unintended consequences. I don't think they understood what they were doing was debasing currency. When they learned it, they're like, oh, this is magic. Let's just keep pressing the magic button. Assets go up, and we're saved from ever a debt deflation.
As nations grapple with the demographic shift towards aging populations, a looming concern arises: the intricate interplay between demographic trends and their implications on economic stability, particularly concerning debt dynamics. At the heart of this issue lies a paradox. While the increasing number of older individuals signifies longer life expectancy and advancements in healthcare, it also presents challenges, notably in financial markets and debt management. The presence of a sizable cohort of older people holding significant equity stakes within the market landscape is a double-edged sword. On one hand, their participation injects stability and experience, contributing to market liquidity and functioning. However, this demographic bulge also amplifies vulnerability to market fluctuations. Imagine a scenario where a substantial market crash occurs. The ramifications would reverberate profoundly, especially for older investors heavily invested in equities. A plunge in stock values would swiftly erode a substantial portion of their accumulated wealth, leaving retirees and soon-to-be retirees financially vulnerable and uncertain about their future security. Yet, the repercussions of such a crash extend beyond individual portfolios. The broader economy would feel the shockwaves, as declining asset values trigger ripple effects across various sectors. Moreover, the cascade of wealth erosion among older demographics would exacerbate existing debt challenges. Herein lies the crux of the matter: the symbiotic relationship between demographic trends, market dynamics, and debt sustainability. A significant market downturn not only jeopardizes individual financial security, but also strains the broader economic framework by amplifying debt burdens. For policymakers and financial institutions, navigating this intricate terrain demands a multifaceted approach. Proactive measures to mitigate market volatility, coupled with prudent debt management strategies, become imperative. Moreover, fostering financial literacy and promoting diversified investment portfolios among aging populations can enhance resilience in the face of market uncertainties.
What is this smart contract business? So I want people to understand that everything humans do is basically a contract. All societies are organized by contracts. Me appearing with you was a contract over email. Even how societies work, how religions work, everything they're contracts. Some are not that important. Like meeting a friend for a drink, you can say, hey, listen, I can't make it. Nobody's going to sue you for it. It might cost you more drinks next time, but that kind of thing. But others are really important. Insurance contracts, derivative contracts, contracts for ownership of property. All of this can now be digital, so you don't have to trust a third party. So we're away from the system of money. We're now talking about verified truth, electronically verifiable truth done by code. So that means we can then get rid of middlemen all over the place. And we've all spent too much money on lawyers. We've all spent too much money on accountants. We've all spent money with notaries. All of this stuff disappears. Things like insurance companies don't need to be insurance companies anymore. They're just contracts of payments and contracts for pooling of capital. So it can be in literally anything, from a ticket to a sports event to the most complex derivative contract in the world, can actually go on this new rails. So it's much bigger than either of us first thought when we first saw it. It's like, oh wow, question about everything.